Hi, let's talk a little bit about inventory now. So any company that sells a product would have to carry inventory. And there's two primary ways that they can account for the inventory that they bring into their system. One is called a perpetual inventory system, and the other one is perpetual, and the other is a periodic inventory system. So under a periodic inventory system, there's no attempt to account for the inventory that's been sold and to take it out of inventory or to charge it to our expense account cost of goods sold until the end of an accounting period. Under perpetual inventory system, every time a piece of merchandise is sold, that merchandise comes out of our inventory and it gets charged to our cost of goods sold. So the perpetual is a much more up-to-date system, and with computers these days it makes it very easy for companies to keep track of their inventory on an ongoing basis, as opposed to let's wait till the end of the month till we go out and check and see how much we've sold. I read somewhere Walmart, within 20 minutes of you buying something and scanning it through their register, their counts are updated, and their cost of goods sold will be charged there. So when we buy merchandise and bring it into the business, this would be our journal entry. So we would debit inventory, which is an asset, so we're increasing our asset inventory, and we credit cash, which is also an asset, or we credit accounts payable, which would be a liability, at which point we would have to pay that eventually at some point with cash. Now when we actually sell the merchandise, it's a two-part journal entry. It's not illustrated here, but there would be two parts. This is the second part to the journal entry. So when we make a sale of merchandise, we actually would debit our cash or our accounts receivable for the sale, depending on whether the customer was paying us cash or paying us later, and we would credit our revenue account, sales. Then we would take the merchandise out of our inventory, so we have to credit our inventory account for the amount that we paid for that merchandise, and debit cost of goods sold, again, for what we paid for it. That first part of the journal entry where we debit cash or credit sales, that would be at the retail price, what the customer pays us. But this entry here would be for the cost of the merchandise, cost of what we paid for the merchandise. The problem then becomes, how do we determine the cost? For example, if you're Home Depot and you work in the nuts and bolts aisle, and a customer, you have a big bin of bolts, some cost you 10 cents, some cost you 30 cents. Sometimes if it's the same bolts and you've just had a price increase, it's impossible to know exactly which one the customer's taking out of the bin. So there are a couple different ways that we can handle that. And there's 4 inventory cost flow assumptions that we can use to account for our inventory. One is called specific identification, the other weighted average, then we have FIFO here and LIFO. So let's go ahead and look at those, and we're going to use just a very basic generalized overview of how the systems work here. So let's say we sell bicycles and we have cost of goods available for sale. So in our inventory at the end of August, we would have 55 units available for sale. We started the month with 10 units in inventory, and then we purchased an additional 45 units during the month. Now those purchases were all made at different prices, and this is very common. You guys go to the gas station quite frequently, and price does vary. Now businesses try not to raise their prices quite as frequently as gas stations, but it can happen that you'll have a price increase and you'll have the same goods on the floor for sale that have cost us different amounts. Then it says they sold 43 units during the month, and you can see here what these sales were, and they were also sold at different prices. So under specific identification, what we want to do is specifically track the items that come in and out. So for example, I have a little TV set here. So if you're Best Buy, you could probably, well, maybe not Best Buy, but a small mom and pop TV store might be able to say, well, even though these 3 TVs are identical, this one that was sold only cost me $700. This one that was sold cost me $800, and I still have one left in ending inventory that cost me $750. Probably a better illustration would be a car dealer. So every car that a car dealer sells has a unique cost to that particular car. So they will be able to pull their invoice on that particular car when it's time to sell, and they can use that as the cost of goods sold and the expense. So specific identification is only good when the items are very unique and can be individually tracked. So for most companies, it's not feasible to use specific identification. Then we have something called weighted average. So this will just take an average of the cost and we can apply that. And the calculation here is you take the cost of goods available for sale during the year, the dollar amount, and divide that by the number of units available for sale during the year. So if we would go back and look at those purchases that we had in inventory or our cost of goods available for sale, we had 55 units. And those 55 units cost us $5,990. So take the $5,990 divided by the number of units, which was 55. That means on average, each unit cost us $108.91 if we round that up. So if we sold 43 units, which they said in the problem, we multiply that times our average cost. That means our cost of goods sold would be debited for $4,683.09, and our inventory would be credited for that amount. And then left in our ending inventory, we would still have 12 units. The 55 minus the 43 sold leaves us with 12 units. And those costs would have an inventory balance sitting on our balance sheet of $1,306.91. Again, the average cost times those number of units. Then we get into the two that are a little bit more complex. And again, we're still going to use a simplified illustration here. So FIFO stands for first in, first out, and it's very descriptive. The first merchandise purchased, we assume, will be the first ones out the door. It doesn't necessarily correlate with the flow of the merchandise, but we are going to assume that. So it's kind of like at Walmart if you buy milk. They always push the oldest milk to the front because that was the first milk that came in their door and they want it to go out. So they have fresher stuff in the back, older stuff they need to sell because it's perishable. Again, it doesn't necessarily mean that your goods have to flow that way though. So under FIFO, since the cost of the earliest goods purchased are the first to be recognized in cost of goods sold, that means you'll have more recent costs in your ending inventory, and the oldest cost will be charged to your cost of goods sold. Let me give you an example here. So again, the first in, first out. So the August 1st purchase would be the first ones to go out the door, then the August 3rd, then August 17th, and then August 28th. So anything we have left in our ending inventory will come from the bottom. Anything we sell will first flow from the top ones first. So if we sold 43 units during the month, that means we would need to sell these 10 plus these 15. That gives us 25 minus 43. That means we also need to pull 18 units from this August 17th purchase. And that's how we address the costs here. So 10 units that cost us $91, 15 units at $106, and 18 units from this 115. Add those up. That means our cost of goods sold, our expense account, will be charged for $4,570. In our ending inventory, we are left remaining with the last goods that were purchased. So 10 at 119 and 2 of the units from the August 17th purchase at 115. That's a total of 12 units left in ending inventory at a cost of $1,420. Now, last in, first out is the opposite. It assumes the latest goods purchased are going to be the first ones out the door. Now this note here seldom coincides with the actual physical flow of inventory unless you have some really lazy stock people that always put the fresh stuff out front. But again, this is just the way we're costing, so it has no correlation to the way the goods are actually sold. And so the cost of the latest goods purchased are the first to be sold. So we have recent costs being charged to cost of goods sold. Oldest cost will remain in ending inventory. Again, same illustration here. We're still selling 43 units. Now remember, last in, first out. So the last ones in are the first ones out. So you'll see we need to pull 10 from the last group of purchases that were cost us $119. 20 from this August 17th group, and that would be 30. We still need 13 more. We'll pull 13 from this August 3rd purchase at $106. Do the math, multiply those out, add them up. So that means our cost of goods sold should be charged $4,868. Excuse my phone there. And our ending inventory, we would be left with 12 units. So 10 from this $91 purchase and 2 at this $106 purchase. So that's $1,122. And just to show you, let me go back. Just to show you, 43% of all companies use FIFO, 34% use LIFO, 20% average cost, and 3% other. And you're like, well, why would one company choose one over the other? Well, assuming we're in a period of rising prices, which is traditionally what happens, here's the illustrations, and all of these have the same amount of sales, but cost of goods sold varies depending on the method we choose. So in a period of rising prices, you can see specific identification would be the most accurate. It tells you what our gross profit is. Operating expenses don't change, but it does impact your income before taxes and the income tax expense that a company will pay. So net income is 713 under specific identification. It would be 721 under FIFO, 609 under LIFO, and weighted average $685. So it falls right in the middle. Now, most business managers are compensated a bonus based on how well their company performs. So if you are based on how well your company performs, would you prefer FIFO inventory method or LIFO inventory method? My guess is FIFO. So you can show a higher net income and make it appear that your company is more profitable. Now under LIFO, you can see here we're showing the lowest net income, which also means we're going to have the lowest income tax expense. So if I were a small business owner, my objective rather than to show high net income would be to actually show less so I can pay fewer taxes. So I might choose LIFO in that instance. So hopefully that clarifies some things up for everybody. Thank you.